My name is William George and I work on the investments team here at Excelsior Capital. Today I wanted to briefly discuss the commercial real estate debt markets and the different options that you'll see different sponsors use. There's really two different buckets. First, there's long-term fixed rate loans, and then there's shorter-term fixed and or floating loans. For long-term fixed, there's really two primary sources. The first is CMBS, commercial mortgage-backed securities, and those are typically the most aggressive real estate loans that you'll see. Now, with those aggressive terms come a lot of structure and a lot of nuance to get a deal closed. Second, there's life insurance companies. They also will issue long-term fixed-rate debt, and when I say long-term, I'm generally talking about 10 years. Though you will see some 5- and 7-year terms as well. Life insurance companies, they're a little less aggressive than your CMBS debt, meaning you're going to have less interest-only period, maybe a slightly higher rate, but there's less structure around the loans, and they're typically a little less nuanced, a little easier to get closed. Those are the two primary sources of long-term debt. On the shorter-term side, shorter-term to medium-length side, there's really three different types of lenders that you'll see. The first that we frequently utilize is your traditional bank balance sheet lenders. And that also includes your credit unions and your community banks too. Generally, these loan terms are around 5 years. I've seen 3 years as well, and some will even go shorter. But you're typically talking about a 5-year term. It can be either fixed or floating rate. Generally speaking, their rates are going to be a little higher than what you're going to see in the CMBS or LifeCo market, and you're going to have less interest-only opportunity as well. Oftentimes they'll require personal recourse liability on their loans too, which a lot of sponsors don't like having for obvious reasons. However, in an environment like we are in today, where debt is hard to come by, CMBS and LifeCo are all but out of the market. It might be your only real option to get a deal done. On top of your traditional balance sheet lenders, there's also bridge lenders, which will give loans, as short as 2 to 3 months to as long as 18 months. And those are typically utilized in between transactions, when a buyer or an owner really just needs a temporary debt source until they sell or they put on a more permanent solution. It's common now because groups aren't in love with the debt options that they're seeing in the market today. So they'll put on a year or 18 months worth of bridge debt, and that allows them to kick the can down the road and then reevaluate the marketplace a year from now. And then last, you have your private lenders or your debt funds. We have never utilized these, and typically they are very specialized lenders that will focus on a niche or a specialized asset class. But they are a viable option that should be mentioned that many sponsors do use.